Good afternoon, everyone, and welcome to the 12 o'clock slot. Each of the trusts we've invited to speak today are designed to achieve a specific outcome for investors, and the importance of the next one was underlined very vividly last year, and that is capital protection. Looking at a chart of this trust performance last year, it's easy to think you've got the dates wrong. When the markets around the world were in free fall, this trust registered a slight dip and then continued to tick up. It's not the first time the trust has bucked the trend during a black swan event. It delivered positive returns of 25% in 2008 when the market lost 30%. Investing in a broadly diversified portfolio with many different asset classes, Ruffer Investment Company aims to achieve net annual total returns of at least twice the Bank of England base rate, regardless of what's happening in the world, and it's done so since inception with great aplomb. To explain how this has been achieved, and to tell us how they see the terminal phase of the COVID crisis unfolding and what will follow it, I'm pleased to introduce the managers Hamish, Baillie and Duncan MacInnes.
Thank you, Pascal, and thank you all for joining us for this seminar. I'm Hamish, Baillie, and together with Duncan, we're the co-managers of the Ruffer Investment Company. So today we've got 30 minutes, and then we'll take questions. But we really just wanted to answer these three questions. We've been slotted into the capital preservation part of this series, and so we thought it was right to ask the question: how do we approach that question of capital preservation? So if we go on to the next slide, we really have two very simple objectives. This is for Ruffer LLP as a business, which is not to lose money in any rolling 12-month period and try and do better than cash on deposit. The investment trust specifically targets twice Bank of England bank rate, as Pascal said. So what does that really mean? I mean, both those objectives really get you to one place, and that is a preoccupation with managing the risk of losing money. That's really what we're looking at. We're saying what could go wrong and how can we protect against that. So we certainly, we like to think we sort of challenge market certainties, and hopefully we provide genuine protection in times of market stress. That's really the role we want to play for our investors. Is it's something that is behaving differently and is hopefully holding its own when other assets are falling in value. So I think the bottom line here is think of us as all weather. That's how we define what we do. So over on to the next slide. How do we do that? Well, it's running a balance really of what we describe as protective and growth investments. So investments tend to be equities to capture the good times in markets, but we're always running with some protection in place. And as you'll see in a minute, that protection will evolve over time. But the idea is that it genuinely needs to be diversified against our risk exposure elsewhere. I think what we've all seen too much in the past is multi-asset funds who bill themselves as being diversified pools of assets, but actually in a crisis, all these things seem to have a correlation of one, and hence money is lost. So your offsets, they can't just be cash or cash proxies that sit still. They need to actually go up in a crisis. Next slide, please. Don't please strain your eyes too hard to work out all the different colors on here. We will circulate the presentation afterwards, but the point we wanted to get across here is looking over 20 years of data at the Ruffer strategy. Clearly the asset allocation has to be dynamic. You can't just have one template that is going to serve you for all market environments. And our asset allocation, it tends to, there are assets that we will hold for long periods of time, but then it can move very quickly when it needs. The best examples of this were probably after the financial crisis, when we switched from conventional government bonds into index-linked government bonds over the course of a few weeks. And last year we shift 15% of the portfolio went into US tips after the falls in March. So we can move quickly when we need to, but the idea is to build up these positions ahead of the time when they're needed. Next slide, please. So looking back over the very long term, what we've used here is data that is not for the Ruffer Investment Company, because Ruffer LLP was founded back in late 1994. So the advantage of showing you this longer term series is it captures another bull and bear cycle in the market. We will show you the numbers for the Ruffer Investment Company in a minute, which you'll see look very similar. The point I really wanted to make here was twofold. One is sort of what purpose can a capital preservation type trust like Ruffer play for you? And the second is sort of beware of some of the darker sides of that. So the green line is Ruffer, and I think that there are two points here. Firstly, I mentioned all weather. So if you took the blue line off the page, I think it would be quite difficult to guess where the bull and the bear markets were. So I think that sort of ticks the all weather bucket. The second is the strength of compounding. So if we can avoid losing money in falling markets, then because when the good times return, we're compounding on a higher base, that we feel gives us an advantage. Now, the darker side of this, which I referred to, is if you look at these three phases here that we've highlighted, when the market has been at its sort of most exuberant phase, we will tend to underperform at that scenario. But if we flick over the page, what that means is hopefully we can keep going through, keep making money through the bear market that follows. So sure, our investors need to be patient. You can stick with through the cycle, then hopefully that patience. Say there have now been 3 bear markets. Last time we did this, there were only 2, but there are 3 bear markets now where we have produced, well, we've protected capital and produced positive returns through those scenarios. Next slide, please. So this is a question we're asked a lot. How do we differ from the other conventional capital preservation trusts and the listed hedge funds? And I think philosophically, we're quite close to both these camps. Clearly, we have this eye on not losing money. That's an important part of what goes on. But I think the way we do that is very different. I think in the more conventional approaches, there's an emphasis on sort of softening the blow. So when markets fall, you know, you want to have cash and lots of dry powder that you can deploy into bombed out markets. Whereas we want our protection to actually be going up in value. That allows us to take more risk with our equity book. If you flip over the page, Duncan, what we're looking at here is green line is Ruffer's correlation to equities, and the blue line is the performance of UK equities going back to 1997. And this is where I think the point ties in with listed hedge fund type vehicles, where what we are quite proud of is that our sort of correlation with equities is quite dynamic. So when the green line is high, that means that we're hopefully managed to capture some of the upside in equities. But then what you see in a bear phase in markets, our correlation falls very sharply. So that's when we're in sort of capital preservation mode. And this isn't a deliberate decision to say, you know, now is the time to take all the chips off the table, now is the time to put them on. But the nature of the protective assets we hold means that they really kick in a crisis. And so that's why the correlation falls sharply. So hopefully that is a very useful thing for investors who are looking for an asset that will add diversification to their portfolio. And on the next slide, we really show that in a slightly different way, which is incorporating Ruffer into your mix of investments hopefully improves your risk-adjusted return or increases your Sharpe or Sortino ratio, if you like to look at things like that. Because if we can lower volatility, then hopefully what we're doing is producing better risk-adjusted returns. And of course, you know, the other advantage is if you do need to call on your savings during a crisis, then we can be there hopefully to be called upon.
Right. Thanks, Hamish. Good morning, everyone, or good afternoon. Right, so here, moving on to Ruffer Investment Company, is the long-term performance of the investment trust going back to its inception in 2004. Since that inception, RICA has annualized at 7.7% per annum after fees and survived and thrived in the 2 bear markets in that time. Over the last 5 years, the compound return is 7.1%, which is getting to look like a decent number and includes the fallow years of 2017 and 2018, where, as many of you know, the portfolio was flat. So moving on to this slide, as Hamish covered, we're multi-asset, go anywhere, unbenchmarked investors, and that means that what we can do is own any of these assets on this scatter chart, and the skill or the art is to own different amounts of them at different times and to put them together in the context of a portfolio so that you capture as much as possible of the return, but you limit the risk. And you can see that we have, for the most part, done that by capturing equity-like returns, but with bond or hedge fund-like volatility, and that creates an attractive Sharpe ratio, as you can see down at the bottom right for the risk-adjusted returns. But I think from a shareholder's perspective, what is great about the Ruffer performance is that we're not correlated to anything. No other fund in the capital preservation or multi-asset peer group or any asset class. And so we add something genuinely idiosyncratic into your overall portfolio. And hopefully you can see why that is as we go on to talk about some of the tools that we use in the portfolio, which are different to the toolkit that many of our competitors use. So this is an attribution table. We talk about building this all-weather portfolio, and in 2020 we clearly had some pretty dramatically different types of weather. And this shows how the portfolio performed in two completely opposite environments. March 2020 was the point of maximum pain in markets, and November, or you could look at April, were months where markets were recovering strongly, firstly because of stimulus and secondly because of the vaccine. But the important point is that Ruffer made money in all 3 months, the despair, the bailout, and then the vaccine rally. And the portfolio was flat for the year at the point of the March lows when equities were down about 30%. So what this allowed us to do was to be on the front foot in March, selling down our protection as it had done its job and adding to US tips at the long end and gold equities, because we could see the huge monetary and fiscal policy response from governments and central banks. Now, of course, today, in hindsight, I think we should put our hands up and say we should have added more to equities at the same time. But as you will remember, things were pretty uncertain back in March 2020, and it wasn't at all clear what was going to happen. And we did do, I think, a decent job of pivoting the portfolio towards riskier assets. In Q4, of course, it was all about the vaccine announcements and a value rotation. We were pretty well positioned for that with an equity book focused on value, cyclicals, recovery, reopening. And as you can see from the right-hand side of the chart there, we were running with much less protection at that stage because we were more optimistic. And so we didn't have the protections holding the portfolio back, and we got to capture much of that rise in equities that you can see with stocks like Valsi and Aina, which own airports, and Cemex or ArcelorMittal, which are geared into stimulus and infrastructure hopes. So moving on to 2021, we're off to a pretty good start so far this year, up more than 4% to the end of February. The other interesting thing to note is that the 12-month performance from end of February last year to end of February a few days ago is 24.2%, and the share price return is 31% as we've moved from a small discount to a premium. So that's just a reminder that we do like sometimes to take risk and make money when from time to time when we think that the environment is favorable. We're not perma bears. So the vaccine rollout has been going pretty well to varying degrees around the world, and investors are starting to imagine what things will look like as the economy reopens. And that means that cyclicals, financials, value stocks are continuing to rally as that path to reopening and improved economic growth emerges. The exposure to Bitcoin has been a help, adding 2% to the portfolio in 2021, 4% to the portfolio return since November. But to dispel any doubts, Bitcoin has only contributed 1/6 of our gains in the last 12 months, so it's far from the only thing that's been working. On the negative side of the ledger, you will see quite clearly that index-linked bonds have sold off 14% and cost the portfolio as yields have risen because interest rate expectations have moved up from rock bottom. And what's interesting there is that the start to 2021 for the market as a whole hasn't really been that volatile, but it has proven to be tricky for multi-asset portfolios. Bond yields up, so that means bonds down, rising sterling, hurting everything that investors have overseas, and of course the continuation of the value rotation, meaning that the much loved stocks have been underperforming. So that's hurt conventional portfolios and many of our competitors. So how have we managed to avoid the pain from rising rates when we have 30% of our portfolio in long duration inflation-linked bonds? The answer, as you can see in the top bar there, is the well-timed use of pair swaptions. So for those of you who are not familiar, that's options which rise in value when bond yields rise, and they've been very significant year to date. And these are the same type of options that allowed us to survive the taper tantrum back in 2013 when bond yields similarly spiked up and spooked markets. And being able to deploy these sorts of option protections is incredibly useful for us, because it means we don't have to think about selling our bonds to reduce the portfolio duration for tactical reasons when we remain very confident that these are the right assets to be in for the long term. Furthermore, also worth noting that there's been signs of life in the much maligned UK banks. We have 5% of the portfolio there, and those were up 20% in February as a direct beneficiary from the idea of bond yields rising and growth expectations improving. Hamish, it's over to you.
Thank you. Back, what we'd like to do now is look at our current asset allocation and look forward and say, answer that question. What are the threats and opportunities that exist at the moment through that sort of capital preservation lens? And we often describe the Ruffer portfolio as a three-legged stool. So there's a codependence between the different assets in the portfolio. We have some volatile assets that we invest in, but we try and offset some of that risk, as Duncan has just given a good example of, between long-dated index-linked bonds and pair swaptions. So keep that in mind as we go through this, that there are three legs to this stool, and it's important how they all tie together. But the first leg of the stool that I want to talk about are alternative protections. What I mean by this, derivatives, credit default swaps being the main things. So actually, Duncan, that's fine if you want to flip over. I guess the first question is, why bother? Why invest in these instruments? Can't you find protection elsewhere in conventional assets? And the answer is that we do still use conventional assets. The US dollar, gold, and bonds are all important parts of the armory. We're currently in index-linked bonds, but the idea of the 60-40 portfolio, which has benefited our business and indeed our industry hugely over the last 25 years, may be entering into a different regime where it is less effective. And why do I say that? So if you've got 60% in equities, 40% in bonds, the theory is that your equities capture the upside in markets, and then the bonds soften the blow in the bear market there. Now, the level that bond yields are at the moment means that offset from bonds is much less powerful than it was. So this is something that I think is really important for all investors, not just capital preservation investors. And what we've shown on the chart here, and it's amazing how quickly this data has become out of date, but when we struck it, the green bars are where 10-year bond yields are in the US and the UK. And what we were saying is, okay, if we had a 10% fall in equities, a relatively small fall in equities, how far would bond yields have to fall to offset that loss in a 60-40 portfolio? And the results are pretty staggering. The idea of US bonds going to negative 0.4 or in the UK to minus 1.2 is highly unlikely, I think. And so, what that says to us is that sort of 60-40 balanced portfolio is carrying more risk than might be apparent through historical analysis. So these are a critical part of our armory. I think it's a really key differentiator for the Ruffer investment company, holding these unconventional assets. So that's the risk. Duncan, if you flick over, the opportunity here, I think largely comes through are credit protection, so credit default swaps. And what we were saying pre-COVID is there was an extraordinary distortion in credit markets. This is corporate bond markets in the US. And the blue line shows effectively the level of indebtedness of the corporate sector, so corporate debt to GDP. And the green line is the spread of junk bonds over US Treasuries, so the reward you're getting for the risk of lending to these companies. And normally, of course, high levels of indebtedness means more risk, means investors should get compensated more. And pre-COVID, there was this big gap between the green and the blue lines. Now, of course, this is the part of the portfolio that did well in the first quarter of last year, and as that green line spikes up the page, that's where the sort of 8% we had invested in this sort of credit protection, that went up 90% in the first quarter. So it can really extremely hard. I don't think we've got time to cover it now, but I'd happy to take questions in the Q&A if you like, as to what, now that the Fed is involved in backstopping parts of the credit market, yeah, has that opportunity gone? The short answer is no, but it's slightly different now. So this is a theme we continue to play, and you can see the effect of the Fed stepping in that green line, spiking sharply down the page.
Thanks, Hamish. Right, so moving on to the second leg of the stool that we talked about. We've long felt that financial repression is the most likely solution to the big problems faced in the world pre-COVID. And of course, those problems were too much debt, too little growth, and widening inequality. And all of those have been exacerbated by the virus and the policy responses to the virus. So our conviction in that end game has strengthened over the course of the last year or so. And there's really only so many ways to fix this problem. You grow faster, you default, or you inflate the debt away. Now, we think default is off the table in polite, modern Western society, so it will be a combination of growth and inflation that solve the problem. And on this chart, you can see how serious the situation is. The US, UK, and Germany are running deficits that have not been seen since the two world wars. Central banks have been effectively monetizing those deficits for governments, and this time all of the stimulus, unlike the financial crisis, is going direct into the real economy rather than being stuck in the banking system. And we think this sort of monetary and fiscal cooperation is here to stay, and this time, unlike 2008, it will lead to higher levels of inflation, but also higher levels of nominal economic growth. Now, as a defense against that sort of world, we think that inflation-linked bonds are very attractive. So we have 30% of the portfolio in what we think will be the key asset for an environment of extended financial repression. And on the chart, you can see what negative real yields do to the price of the 2068 index-linked bond, which it or issues like it are about 8% of our portfolio. And due to their long duration, they offer huge convexity to this scenario that we're discussing. So the key driver for the price of an inflation-linked bond is the difference between two variables, interest rates and inflation. And we know with a high degree of certainty that central bankers are determined to pin interest rates as low as possible. And now there's clarity that they are equally determined to stimulate inflation and to run the economy hot from current low levels. That means the gap between the two should widen, and we'll move further out along the horizontal axis on this chart. And therefore you can say that if central bankers are successful in their stated goals, they will create an environment that is perfect for inflation-linked bonds. It's also an environment that is pretty good for gold. It's an attractive asset because it hedges against that inflation, but it also hedges against geopolitical instability, which we may see some of in the future. James Grant famously said that the gold price is the reciprocal of faith in central bankers, and that to us feels like something that's quite likely to decline over time as we approach the limits of monetary policy. So we've got about 7% of the portfolio in gold and gold bullion and gold mining equities, because it seems quite clear that the mountain of obligations that have accumulated post-COVID are putting, rightly, question marks over debt sustainability and the soundness of fiat currencies. So in that world, buying gold assets which yield 8 to 10% free cash flow yields on equity at the current gold price seems pretty attractive to us. And of course, if the gold price goes up, which we think it might, then that drops straight through to the bottom line profitability of the equities and can have a profound impact on the price. There is also Bitcoin. Now, we have said earlier that we're multi-asset, go anywhere investors, and this really shows it. We've followed Bitcoin for a number of years with interest, but we didn't invest until 2020. Why? And the answer is, as it is with everything these days, coronavirus. The fiscal and monetary policy response, the broadening negative interest rates globally, the acceleration of the war on cash. When was the last time any of you did a cash transaction? And lastly, the digitization of everything has made the idea of purely digital assets no longer seem quite so outlandish. Layer on top of that, what Hamish said earlier, the investing world is crying out for new safe haven and uncorrelated assets. So we built a 2.5% position in November at about $15,000. We've been taking profits as it's risen along the way, some at 35,000, some at 50,000. We still have about 2 to 3% of the portfolio today. But the rationale is that what Bitcoin was, what Bitcoin is today, are both different from what Bitcoin could be in the future. And we think it has the potential to be something like a digital gold. And to the doubters, of which there are many, I would say think of Bitcoin's bad reputation as a risk premium. And as we move through a process of normalization, regulation, institutionalization, and the democratization of access, those risk premiums will compress and the price could rise commensurately. And that was a theory. And over the last few weeks, you've had Tesla, BlackRock, Morgan Stanley, Goldman Sachs, and Bank of New York Mellon all announce investments in the space, which are making it less of a theory and more of a trend. It's a hot topic at the moment. I can see there's lots of questions about it, but it is just 2 to 3% of the portfolio, quite deliberately, because it's volatile, it's risky, and we don't want it to make or break overall portfolio performance. So moving on to the third leg of the stool, equities. Our job is to grow and protect capital in the full range of potential outcomes. It's about a balance of protective and growth assets. So we still have 40% of the portfolio, which is there to benefit from economic growth, improving animal spirits and recovery in the economy. And there are definitely a lot of animal spirits around at the moment, as I'm sure you can all attest. We could have chosen any one of a number of charts here. Savings have spiked in the developed world. We could show you that US household net worth is at all-time highs, excess savings from the crisis, from people being stuck at home, 5% of GDP. Biden stimulus is 10% of GDP. There's a lot of pent-up demand there, and governments are incentivized to run the economy hot, and Jerome Powell has been explicit that they're not going to raise interest rates. So you add all that up together, and we think that that matters because growth has been in short supply in the last few years, and that's why growth stocks have attracted a premium over value stocks. This chart clearly demonstrates that. But a robust recovery with higher economic growth should favour unloved value stocks. And we had a taster of that in November, which was the best month for stock market since 1987, up 10%. But value stocks, of which we have many in our portfolio, were up 20 to 30%. So how are we expressing this in the portfolio? We are continuing with economically sensitive value cyclical stocks, stocks which are sensitive to recovery and reopening. So things like American Express, which is sensitive to travel and consumer spending. UK banks, which I mentioned earlier, land securities and commercial property, UK smaller companies, they have a double discount of Brexit and COVID and should benefit from this wave of M&A that we're seeing in the UK. Or things like Swire Pacific, which trades at just 40% of book value and sits at the cross-section of emerging markets, Hong Kong prime commercial real estate, and owning a business-focused airline in Cathay Pacific. These are businesses, all of which will benefit when the economy recovers and reopens. Hamish.
Thank you, Duncan. So to summarize, we started talking about how we go about capital preservation, the tools we use. We talked a bit about why we think it's relevant, and I think at this point in time, there's probably never been a more compelling argument for holding a capital preservation approach within your mix of assets. And then we talked about the possible scenarios from here, and we've outlined some of these on this slide, and how the portfolio will hopefully capture some of that in order to help us achieve our objectives. So to summarize that, the sort of very benign roaring 20 strong equity markets, hopefully our 40% in equities is well positioned to capture that. Financial repression, that's interest rates being kept below the rate of inflation. This is probably our core highest probability position. Index-linked bonds and gold and cryptocurrency protect against that. I think the lower probability scenario is this one, where the impact of COVID is too severe for the economy to recover. We've given how much has been done already by governments and central banks, we think that is a relatively lower probability, but it's important to acknowledge that risk, and the unconventional protections in particularly in credit markets should help us there. And then finally, the point that I talked about earlier, be careful of conventional bonds and sort of correlations that have lasted for a long time may not work in the future. We may be going into a new regime, so the traditional portfolio may look riskier than it appears. So I'm going to stop there and hand over to Pascal for the questions.
Hi guys, a huge number of questions about Bitcoin. So I won't ask you them all because a lot of them are sort of repeat each other. I think you've already dealt with the basics of why you own it. But I guess to divide it into three, the core questions are: do you really think it's a defensive investment, and how can you sort of demonstrate that? Do you really think it will remain outside government control and regulation? And the third one, I guess, is a more nuanced question, but a very interesting one, is how can you justify the energy cost involved in mining Bitcoin, and are there implications on that front from an ESG point of view?
Right, okay, there's a lot there. I will try and do it in reverse order of energy cost, regulation, and then is it actually a defensive asset? I think that was right. So there's, on the energy side, there is a bit of a misconception. There is no doubt that Bitcoin is electricity intensive, but what really matters is the carbon footprint of the energy intensiveness. And there's a lot of evidence out there that at least 40% of Bitcoin mining, and some estimates have it as high as 70%, is done with renewables, and that's increasing due to the institutionalization of Bitcoin mining, and also because renewables happen to be the cheapest, and that's exactly what Bitcoin needs because it's such a big input cost. So comparing it to things like using more electricity in Argentina is just the wrong way to look at it. If you were to think about it another way, for example, Bitcoin uses just 0.2% of all of the electricity in the world, which doesn't sound like very much, and it uses less electricity than computer games. So if any of you are gamers or have children that are gamers, then that is using more electricity and is more carbon intensive than Bitcoin is. So it's not as big a problem, I think, as the Guardian and BBC headlines would make out. On the regulatory side, I think the chances that government bans it is pretty low. It's possible. And again, that stems from a misconception, I think, that people want Bitcoin to replace the dollar or replace the pound. And that's not what we think will happen. And if that was ever to try to happen, then governments would have a serious issue with it. I think what we're seeing is that the regulatory position will settle upon forcing the bad actors out of Bitcoin. So there's nothing wrong with Bitcoin and cryptocurrencies. In fact, there's lots of good things about them. What you want to do is limit the bad uses or the bad users, and that is definitely happening. And then the third question, or the first question, was about whether or not this is a safe haven asset. I mean, my first reaction is that the investing world is being starved of safe haven assets. You can't sit in cash, you can't own bonds. safe haven blue chip equities and property are all extremely expensive. You can't even be short stocks anymore because of things like GameStop. So the world is having all of its protective assets taken away from it. Wouldn't it be sort of wonderfully ironic if what is perceived as the riskiest asset in the world is actually one of the safe havens? And I think if you just look at the raw numbers to the extent that they are useful, Bitcoin is very helpful from a portfolio perspective because it's not correlated to anything, and it has a low correlation to other assets, and it has had a very high historical return. If that continues, then it can be a very useful asset. But there have also been times when it's been correlated with risk assets, such as March 2020. So that correlation is changing over time, and I think it will be very interesting to see how it pans out over time.
Thanks very much.
So there are a couple of follow-up points that actually came in while you were talking there. If I could just pick those up. There's one good point here that if Bitcoin miners are using renewable energy, that's depriving others who might otherwise be using that electricity. I think that's a valid point, but there is complete flexibility in how Bitcoin miners use their electricity at what times of day, etc. And there's a growing trend towards trying to tap into stranded renewables. So, if you think you've got a hydro scheme where for much of the day that electricity is not needed, and then there are examples of Bitcoin miners who are agreeing with these electricity producers that they will use energy off peak when it's kind of excess supply. The other point that came in was it's very volatile, and I think it's a sort of misunderstanding of the Ruffer philosophy, and probably even actually the whole idea of capital preservation, that holding a range of low volatility assets gives you a sort of capital preservation, low volatility type approach. It may do, but it's not guaranteed. I think if you look at 25 years of what we've done, we've held some very volatile things, fixed call option, S&P put options, even long dated index linked bonds. These are all volatile assets. So it's the way you put those together. And I reiterate what Duncan said, it's owning assets that behave in different ways that is important to the bottom line, hopefully being lower volatility.
Thanks, guys. A couple of questions about the inflation-linked bonds. Do you think your significant allocation to inflation-protected bonds will provide adequate protection in the portfolio in the event of the US long bond yields continuing to rise?
It's a good question here. The short answer is that whether TIPS or UK linkers, these things trade off real yields. So that's the bond yield less inflation expectations. So if long bond yields are going up, but inflation expectations are going up at the same time, then that is not bad. In fact, that is good for index-linked bonds. So I think the scenario that we really hold these for is where inflation expectations are going up faster than bond yields. And that seems quite likely to us because of the position that the Fed and the Bank of England have taken, but also just look around you, look at the level of indebtedness in this society. We saw it in Rishi Sunak's statement yesterday. There's a real desire and necessity to keep bond yields down, and so governments and central banks are going to do whatever they can to keep bond yields down. So if inflation expectations are going up at the same time that that's happening, then that's a very good thing for index-linked bonds. From a portfolio context, this is one of the key risks, I think, for us, that we have an environment where growth is better, so bond yields are going up, but people aren't worried about inflation. And I would have put this down at the beginning of this year as quite a likely scenario, and also one that is a risk to how we're positioned. But as Duncan said, the combination of payer swaptions of UK banks and other cyclical equities is actually has navigated that that potential squall very, very well indeed in the first 2 months of the year.
Sorry, guys. My dog just invaded my room and knocked over a guitar. Okay, so next question. Talking about the assets in the portfolio. Actually, no, there's one more on inflation-linked bonds I want to actually which is given the level of inflation expectations you just talked about, do you think the relationship with ordinary bonds or standard traditional bonds will break, because they've previously been pretty much in lockstep?
Yeah, so but bar one moment in sort of in late 2008 where they diverged, that is correct, that the environment where index-linked bonds excel hasn't really existed since they came into existence in the early 1980s. So they were issued in order to gain credibility, to avoid the mistakes of the 1970s, and we've never really been back into that scenario. So I think it's certainly a shrewd observation, but I honestly don't know where that tipping point is, that suddenly the two of them diverge. But clearly, you can see that if people do start to question, their conventional bonds are being really hurt by inflation, their spending power is being eroded, currency being debased, then at some point, people look for the safer alternative, and that's where we think index-linked bonds really come into their own.
I think if I could just jump in quickly on that one, that is an extra element of the insurance against inflation being higher than people think, is an extra element that you get with an inflation-linked bond that you don't get with a nominal bond. And because it's been effectively useless for 30 years, I think investors don't price it in. And if you listen to Jonathan Ruffer, it's at some point in the inflationary endgame, that will be the bit that is most valuable, the bit that hedges you against the inflation that you effectively, that is greater than you predicted.
Thank you very much. There are a couple of questions about assets in the portfolio. Obviously, it's got a huge range of different things in it already. But one question was whether you think you've ever thought about infrastructure as a potential inflation beating investment, and another was whether you've ever thought about private equity as a way to diversify the things you're invested in.
So infrastructure, yes and no, not against it. The downside is that by definition it's sort of very tied to interest rates, so it's quite a lot of duration in there, and we already have that. And the other is that depending on the asset, it can be quite easily taxed or expropriated by governments. So thinking of utility type assets, that's always a risk. On private equity, we do have a sort of slide on this that we didn't put in the presentation. We don't think it's very attractive. So it's false diversification. In essence, it's ultimately private equity and public equity are both types of equity. So you shouldn't be surprised if they do the same thing.
Thank you. A question that's just come in on the back of what we're talking about with inflation was, how will the portfolio cope with stagflation?
I mean, I guess we've had some of this in previous years, and that's where the sort of conventional bond element of the index linked is sort of comes into spotlight, and they hold up very well. I mean, I think it's quite difficult to really to generalize here, but one would have thought that combination of a sort of a low weighting to equities, some index linked bonds, some gold, some credit strategies, that should navigate that scenario. That's certainly been the case in the past, but I think it really depends on how people are feeling about that. Is it a short-term phenomenon that that people get past, or is it really ingrained? I mean, a question we get a lot is, why will governments be successful in generating inflation, and why don't we go back to into something that looks more like Japan has looked like for the last 2 decades? And I think the bond element of the index linked bonds should do well in that scenario.
So, does the furlough scheme mean that you can't have stagflation? I suppose that's the other thing that sort of cropped up to my mind immediately. That feels a very antiquated concept now that we've seen what governments are willing to do in the last year or so. I mean, wouldn't rule it out, but I think it's less likely than it was.
Thanks both. We've got time for 2 more questions, I think. One is about the discount, and I guess the reason that it's being asked is because this is an absolute return fund, or the focus on capital preservation, why is the board not more active in protecting against a discount and kind of buying back shares?
Yeah, I mean, the short answer is that they've never really needed to. I mean, we've never moved to a significant discount, and they have been pretty active in issuing shares while we've been at a premium to keep a lid on the premium. I think they're entirely open to suggestions on this, but the feedback that we've had thus far is that Ruffer have open-ended funds that have zero discount volatility. So if we want that, then we'll buy the open-ended funds, and we quite like the other advantages of the closed-ended fund, that we can buy in on a discount, that when you're growing, that when Ruffer's business is growing, our assets aren't being diluted by funds flowing in. So I think the board would be absolutely open to suggestions on this, but to date they haven't had to do much. They do have a buyback policy in place. There is also a redemption facility every year. So there are mechanisms in place here, but please send any feedback you have, and I'd be happy to pass that on to the board.
Thank you. Last question, I think a very interesting one, is what market scenario would be the most deleterious to the Ruffer investment company for given its current positioning, were it to unfold tomorrow?
I think, as I said earlier, I think at the beginning of this year, the one that really worried me was a sort of benign economic growth scenario, which meant that bond yields went up, and we wanted to hold these index linked for the next stage. So that really kept me awake at night, because you want to be sure your equities were doing enough to offset what you'd be losing in the linkers in that scenario. The swaptions have made a massive difference there, so that's really helped. So I mean, perhaps if we put that aside, because I wouldn't say we're through this yet, but I think thus far at the very early stages we seem to be navigating this okay. If you go to the opposite extreme of a sort of governments give up, and it's just we're going to go into a deflationary abyss. That's a very difficult scenario. I think it's very low probability, but clearly equity markets are a bloodbath in that scenario. I think there's no value put in the inflation protection, even if the bond element of the linkers does okay. Funnily enough, gold might do okay. The credit protection does very well in that scenario, because it's terrible for the corporate sector. But you really want to be in long dated conventional bonds, and we don't hold any of those. So I put that probably at the top of my list at the moment. But as I say, I think it's, given how far we've travelled, it's very low probability.
That last scenario that Hamish just mentioned is terrible for us in sort of absolute terms, but you'd still, and by terrible I mean we might lose a little bit of money, but in relative terms I think we still probably do all right, because risk assets would just be horrific, and that's why we think it's such an unlikely scenario, because governments just won't let it happen. They can always print more money. That's unfortunately the lesson that they've learned in the last 12 months. Yeah.
Okay, guys. Well, we are slightly over. I'm afraid we've got no more time for questions, although there are plenty more to ask. So we'll be sharing those with you, and we'll try our best to get back to anyone who's asked those questions with an answer. The next session starts in 10 minutes with ICG Enterprise. If you haven't registered yet, you can do so. You'll find an article that lets you do that on the homepage. All that is left to say is thank you very much for joining us, and thank you, Duncan and Hamish, for your fascinating insight.
Thanks.
Bye.